If you die tomorrow, one of your accounts might not even go to your spouse, not your TFSA, not your RRSP, the one you'd least expect. TFSA, RRSP, FHSA, you've probably got all three. Each one plays by a completely different rule when you're gone. Stay for the FHSA part. That's the one that people get confused the most. TFSA first, because out of the three, this is the one you can actually get completely right. Here's the trap though. Most people think naming a beneficiary and naming a successor holder are basically the same thing, just different words on the same form. They're not, and the gap between them is bigger than you'd think. A successor holder can only ever be your spouse or common law partner. Name them that way and the account doesn't close. It just keeps going under their name now. Same TFSA, same tax-free status forever. A beneficiary can be anyone. They still get the money tax-free, but the account itself closes. Both versions sound identical on paper. Tax-free money going to whoever you named. The real difference only shows up in what happens next. Say you've got $80,000 in your TFSA. Successor holder gets them all, $80,000 plus whatever it grows into after that, forever tax-free. Beneficiary gets that same $80,000 tax-free too. But say the estate takes 8 months to settle, and in that time, the account earns $600 in interest. That $600 is taxable to them. One word on a form. That's the entire difference. And if you never name anyone at all, no successor, no beneficiary, the account becomes part of your estate. Probate fees apply. And just like the beneficiary case, anything the account earns after your death still gets taxed. You lose the smoothest option, not the tax bill. TFSA can go tax-free permanently if you fill out the form right. RRSP can't, not ever. And that's not a technicality. It's baked into how the account works. People assume RRSP works just like TFSA. Name your spouse, done, tax-free. It doesn't work like that at all. There's no successor holder option here. Instead, the rule runs through something called a qualified beneficiary, which is your spouse or common law partner. Name your spouse as a qualified beneficiary, and the balance rolls straight into their own RRSP or RRIF. No tax bill today. But don't mistake that for tax-free. It's tax-deferred. They'll pay tax on every dollar eventually whenever they actually withdraw it at whatever rate applies then. Picture $200,000 in your RRSP. Qualified beneficiary named. It rolls into their RRIF. Nothing happens right now. Now picture the other version. Maybe you never named anyone, or maybe there's simply no spouse or common law partner to name. Either way, the outcome's the same. That same $200,000 gets added to your income on your very last tax return, all in 1 year. At around 40%, that's roughly $80,000 gone to tax before your estate hands over a single dollar to anyone. So here's where things actually stand. TFSA can be permanently tax-free. RRSP only ever delays the bill, it never cancels it. And without a spouse to roll it into, that bill lands all at once, immediately. FHSA breaks the pattern completely, and this is the one worth paying attention to. Picture this. A married couple. They've owned their home together for years. One of them dies, holding a maxed-out FHSA, $40,000 in it. The surviving spouse assumes they'll just take it over, same as a TFSA successor holder would. They can't, and here's why. Being the spouse isn't enough on its own. To actually become successor holder of an FHSA, you also have to personally qualify to hold one, at least 18 years of age, a Canadian resident, and, importantly, a first-time home buyer. Spouse and eligible both need checking. This couple already owns their home together, so the surviving spouse fails that second box. Not from any mistake, just from already owning a place. Which means they're treated as a beneficiary instead, and that $40,000 now has exactly 3 paths. Into their own FHSA, but only if they separately qualify, which here they don't. Into their own RRSP or RRIF, tax-deferred, or straight out as cash, fully taxed as income, all $40,000 in a single year. Here's the part almost everyone gets wrong. Transfer to FHSA sounds like the original account just continues on the way a TFSA would. It doesn't. The surviving spouse would be opening a brand new account in their own name, and only if they qualify to open one in the first place. And if there's no spouse at all, never married, no common law partner, there's no successor holder option to begin with. It goes straight to whoever's named as beneficiary or the estate and gets taxed as income the same way. 3 accounts, 3 completely different outcomes when you're gone. TFSA, tax-free permanently if the right person is named the right way. RRSP, deferred, never fully tax-free no matter who inherits it. FHSA, depends entirely on whether the person you love still qualifies to hold one, and for most couples who already own a home, they don't. When you first opened these accounts, there was a line asking who should get this if something happened to you, successor holder or beneficiary. Most people fill it in once in a hurry and never think about it again. Go check what you actually put down on all 3. It's the only thing standing between your family getting this without any complications whenever it's time. If this made it clearer, hit subscribe. Canadian Life Simply Explained. See you in the next video.